Asia is a sector of the world that is poised with a lot of growth, as we've seen with so many articles. In fact, there are a lot of predictions that state that China will overtake the US economy by as early as 2028, which presents a great investment opportunity if these predictions are correct. So how can you take advantage of this? Hey guys, welcome back to the channel. My name is Fyzee. On this channel, we look at Australian personal finance, and today we are exploring 4 great Asian ETFs listed right here on the ASX that you can buy and diversify your portfolio. Now, before we get to it, I just want to say, as always, this is not financial advice. I'm not a financial advisor. I just have a passion for finance and investing, same as you, so let's get to it. Now, the first ETF we're going to look at is ASX Asia. This is the Beta Shares Asia Technology Tigers ETF, and what this ETF does is that it tracks the 50 largest Asian technology companies in Asia, of course, excluding Japan. So let's have a quick look at the returns so far. Now, as of today, which is the 26th of February, the tech sector has gone down a little bit, as you can see. The 1-year return has been still quite good though, at about 64%. And just in the last week or so, the returns have been quite negative at about minus 13%. So we can say that this ETF may be at a discount. Now, with this ETF, you probably might be familiar with this one because I would say that this is one of the more popular ETFs when it comes to Asian diversification. So let's just get into the specifics. So as you guys can see, the fund objective is to track the 50 largest tech companies and online retail stocks in Asia, including companies like Alibaba, Tencent, Baidu, JD.com. Now, the interesting thing about this ETF is that it's targeted mainly towards technology, and based on this information here, we can see Asia is surpassing the West in terms of technological adoption, and the sector is anticipated to grow. Now, as you guys can see, there's been a bit of a drop here of 4.26%, as we discussed earlier. The management fees for this one are 0.67%, which might seem quite high if you compare this to other broad market ETFs. The distribution frequency is annually. That means you get an annual dividend. Now let's look at the top 10 holdings of this ETF. So first we've got Samsung, which basically needs no introduction. The weighting is 10.8%. And the second largest holding is Taiwan Semiconductor Manufacturing, which has a weighting of about 10.6%. Now, basically, this company creates semiconductors and actually supplies its semiconductors to Apple as well, which I thought was pretty interesting. And thirdly, we've got a company called Meituan, which has a weighting of around 9.7%. Now, basically, Meituan is a shopping platform for dining, entertainment, delivery, travel, and those sort of things. And the company is over 10 years old. And the fourth largest holding is Tencent Holdings at about 9.5%. Now, Tencent owns WeChat, which is one of the largest social media networks in China, and I'm sure you've heard about this company because it's quite huge. Now, let's have a quick look at the sector allocation, and you guys can see that the biggest allocations are the internet and direct marketing retail. Then we have semiconductors, then interactive media and services, and so on and so on. And the country allocation is largely based in China at a massive 55%, second with Taiwan at 21%, and South Korea, India, and a bit of Hong Kong as well. Now, I just want to point out something. If we have a quick look at the graph once again, you guys can see that the 1-year return is quite good at about 64%, as we mentioned earlier. It's important to note that although these returns are absolutely amazing, this is no indicator of future performance. And I'm guilty of this just as much as anyone. Now, secondly, another thing that you need to watch out for is that this ETF does not include any Japanese stocks whatsoever, and I'm not too sure why. But if you do want to invest in the Japanese economy, stick around. I've got an ETF that does that as well. Now, the second ETF on this list is ASX IAA. This is the iShares Asia 50 ETF. And let's have a quick look at the returns. So as we can see, it's down once again at about 2.4%, which is similar in trend with the Asia ETF. The 1-year return is about 27%. And you can say the 5-ish year return is about 117%. So if you invested in this ETF 5 years ago, you would have doubled your money. Now, this ETF is by BlackRock, and this is quite similar to Asia in a sense that it also holds 50 companies. Now, let's look at the details. So the management fee is 0.5%. If you compare that to Asia, Asia's fees were 0.67%. So it's a bit cheaper than the Asia ETF. And a positive thing of this ETF is that in 2018, it was converted to an Australian domiciled iShares ETF, which means that you don't need to complete the US tax form. And we've got some information here like the inception date, the rebalance frequency is quarterly, it pays a semi-annual dividend. Now, if we compare this to Asia, the frequency of dividends is doubled because Asia pays an annual dividend. So with the holdings, we've got 16.5% in Tencent, Taiwan Semiconductor is 14%, Samsung Electronics is 12.6%, Meituan is 6%. Now, an important thing to note between this ETF and Asia is that if we actually add up the weightings for Tencent, Taiwan Semiconductor, and Samsung. This is about 45% of the overall holdings for this ETF, but for those same companies, this is about 30% for Asia. So basically what I'm saying is that these three companies are close to being half of this ETF's holdings, while with the Asia ETF, these three companies are close to being 1/3 of the ETF's holdings. So if we look at the exposure, we can see that China is about 35.6%. Compared to Asia, this was about 55% in China, so there's a massive 20% difference. Korea is about 27%, Taiwan is 21%, Hong Kong is 13%. In Asia, Hong Kong was less than 1%, so there's a bit of a difference there. Now back to Asia, and the country allocation was about 5% for India, whereas with this ETF, there is basically no India to be found. Now once again, there is no Japan to be found here anywhere, so depending on which country you are most bullish in, you can look at these exposure breakdowns and invest accordingly. Now also keep in mind that these allocations are subject to change. The third ETF is IJP. Finally, we have an ETF that tracks the Japanese market. And this is the iShares MSCI Japan ETF. The returns for 1 year are about 5.5%, and if you look at the 5-year return, that's around 40%. Now this ETF is about 1 basis point cheaper than IAA, the ETF that we discussed earlier, because the management fee is 0.49%, and this ETF tries to cover 85% of the Japanese stock market. Now similarly to the ETF that we looked at before, the dividends are paid out semi-annually, and one important thing of this ETF is that you can see the weights are quite small, which means that it's much more diversified, because this ETF tracks around 300 different companies from Japan. Now in Australia we have VAS, which tracks the ASX 300, so this ETF is a bit similar to VAS. Now also keep in mind that this ETF is tracking Japan and Japan only, just one country, which means that you are exposed to risk that is specific to Japan, so just be mindful. Now I included this ETF in this list because the other 3 ETFs don't have Japan at all, and I figured if someone out there wants to invest in the Japanese economy, this could be a decent option. Now the last ETF we're going to look at is VAE. This is the Vanguard FTSE Asia X Japan Shares Index ETF. That was such a mouthful, but this video would not be complete if we didn't have a Vanguard ETF. So let's have a quick look at the returns, and the 1 year return seems to be quite good at about 15%. If we look at the 5-year return, we are sitting at somewhere around 68%, which is quite good as well. Now some quick facts about this ETF. It's based in Australia, so you don't need to complete the US tax form. It's been running for around 5 years. The management fee is 0.4%, which is quite good. In true Vanguard fashion, it's the lowest fees out of all these ETFs on this list. Now, if we look at the holdings for this ETF, it has the most amount of holdings at about 1,426. If we have a quick look at the sector allocation, it's consumer digital services, which is about 11%, semiconductors, computer hardware. So as you guys can see, this is more tech and electronic focused. And if we look at the market allocation, we've got China at the top at about 43%, Taiwan, Korea, and India, which is 10.1%, which is quite high. In fact, this is the highest out of all 3 other ETFs. Now, if you look at the countries in this list as well, you've got Malaysia, Indonesia, Philippines, Singapore, so it's a lot more diversified out of all other ETFs as well. Now, if we compare this ETF to the other 2 ETFs, IAA and Asia, those ETFs only held 50 companies, where this ETF holds such a big bag of other companies. So if you want to capture the whole of Asia, this could be a good option. Now, if we look at the holdings, we've got Taiwan Semiconductor, Tencent, Alibaba. Now, there's a lot of similar companies in this, but the weightings are a lot less, which fits in the overall theme of this ETF to be heavily diversified. The distributions of this ETF are quarterly, which are much more frequent than the other ETFs. So there you have it, guys, 4 great ETFs to diversify yourself in the Asian markets. And I just want to say there's no best ETF on this list. It really all depends on your strategy. We've gone through some really tech-focused ETFs, some super broad ETFs, an ETF that tracks Japan only. So you've got a broad range of ETFs to choose from. So thanks for watching, guys. Please like and subscribe. And if you enjoyed this video, here are 2 other videos that you might like as well. And I'll see you in the next one. Bye-bye. Now if we look at the holdings, we've got